Hello, my name is Diane Gallagher. I'm from American Century Investments, and I spend a lot of my time, in fact, a lot of my time over the last 25 years or so, talking with individuals about saving for their futures. And in our breakout session today, which is a little different than what we would normally do, we're going to talk a little bit about how important it is to care for yourself while you're being a caregiver. Caring long-term for a loved one has become the norm for many people, especially women. In fact, 1 in 5 Americans has responsibility for caring for an aging relative or a friend. And caregivers expend a tremendous amount of time and energy on this work, and it can be extremely rewarding and extremely gratifying. It can also be pretty difficult, whether you're taking care of daily activities or even complex medical care. But there's another reality too. The majority may sacrifice their own finances, even their own retirement security. But there's hope, and that starts with having a family conversation and a solid plan, ideally before the time comes. So let's use this time right now to talk about how you can develop a plan going forward. So a couple things that we'll step through. First of all, the profile of a family caregiver. Let's talk about who that person is, what he or she looks like. We're going to talk about how caregivers can take a financial hit and what that means, what those implications are, and how important it is to care for your finances right now. Finally, and extremely important, about talking to your family and making sure that we have those conversations before they're necessary. As more of the U.S. population ages, you could find yourself in a caregiver position sooner than you expected. And the profile of a caregiver really crosses the gamut of all of us. 61% of caregivers are women, and it really does impact all generations. Not surprisingly, the largest number of caregivers fall in that baby boom generation, so those are individuals born between 1946 and 1964. But there are large numbers, 23% fall in the millennial category, 6% even in Gen Z are younger friends and colleagues who are caring for an aging relative. Over half of caregivers are caring for an ailing spouse, and the rest are caring for a relative or a close friend. 24% of caregivers actually care for more than one person. So imagine that difficulty of having responsibility for perhaps your spouse as well as a parent or a child or a close friend. It can be incredibly difficult to manage all those expectations and all those requirements over time. And unfortunately, the financial brunt caregivers experience can be significant, not just right now, but in the future as they look at their own retirement security going forward. So it's really important to take a look at the opportunities that we have that we should take advantage of to make sure that our own security stays intact over time. 45% of caregivers report at least one financial impact. That could be anything from having to change jobs, cut hours, prevent saving for retirement. It is a significant challenge for any caregiver as they sacrifice their own security to make sure they're covering those immediate medical needs, caregiving expenses that happen right now. And we talk about other expenses that can be significant. On average, caregivers spend $7,000 a year on expenses. If you're caring for someone out of state or just simply not in the state in which you live, that could be $12,000 a year. So many caregivers find themselves in an instance in which they quit their job, they take a part-time position, or in fact, take a pay cut so they can have some additional flexibility. All of those small actions to take care of something right now can affect your Social Security benefits by reducing them going forward. So it's really important to stay attuned of what trade-offs you're making financially to cover those expenses right now versus the sacrifice that you may be dealing with in the future. And if you are dealing with any of those circumstances, we see you. It is challenging, it's emotional, it's stressful. It can also be very rewarding to be helping someone in their dire time of need. So it's really important that we have these sorts of conversations and make sure we get the help coming forward so that we can make the most appropriate decisions, not only for the folks for whom we are caring, but also for ourselves. So the question is, can you prevent a significant financial impact? Can you take care of your own financial self-care while you're caring for someone else? And the answer is yes. So the first thing you should do is really assess your own financial fitness and really make it a priority. So let's look at 4 steps that you can take to really take a look at your own circumstance. First of all, maintaining control of your own expenses. Second, evaluating your own financial plan. Third, investing regularly for your future. We'll talk about that, how important it is not to stop there. And 4, enlist the help of a financial professional. There are experts who can come to your assistance that you can use to make sure you are making the most appropriate decisions for your circumstance and that of the person you're caring for. So first of all, let's take about your own expenses. No matter what circumstance you're in, no matter what financial needs you personally have, it's really important that you stay on top of your budget and make sure you also have an emergency fund. So as a caregiver, it's important as you reevaluate your budget that you take into account those expenses that are now a part of being a caregiver. So take a look at what your own monthly income is, what the expenses that you're required, your own housing, food, insurance, etc., and make sure you're also factoring in those expenses related to being a caregiver. So you can ask yourself, how do I organize the resources I have to be more prepared down the road? And that also leads into helping you with that second item that is so important, which is an emergency fund. Nothing derails your circumstance more than having something unexpected happen, whether that's the transmission going on your car, a leaky roof, any sort of thing that you have to take care of right now can really put a dent in your short-term and long-term budget. So it's really important to have an emergency fund. So plan on having 3 to 6 months of cash, of liquid assets available to take care of those emergencies. And that will prevent you from having to dip into long-term savings, like your retirement savings, like anything you have put away to cover that immediate need. And the way to kind of get going on an emergency fund is you can pull things out of your budget and make sure you allocate that toward your emergency fund, but also look at any sort of small contribution. If you have your tax refund, for example, or a bonus you weren't expecting, any sort of additional cash that comes your way, put that into your emergency fund so that becomes your cushion to take care of anything unexpected that comes up. So you're not tapping into your savings to cover those. And let's be candid, we all have an emergency that comes up once in a while that we're going to have to take care of. So make sure that you work to have that 3 to 6 months of an emergency fund build up. It's also really important to have a financial plan and evaluate it regularly. And you start with defining your goals. Write them down, put a name to that, whether that's retirement, whether that's paying off your mortgage, whether that's covering college for your children or grandchildren. Assign a goal to every financial objective that you have, put a name to it, and make sure you revisit it regularly as your circumstance changes. So if you're able to pay off your house, which is terrific, you're going to want to change your goal since you've already accomplished that. Also, really look at your risk tolerance. It will vary over the course of your lifetime. So for example, someone who is only 5 years out for retirement has a very different risk tolerance than someone who's just starting their career. Neither is right or wrong, but you need to understand how comfortable you are with the ups and downs of the market. If you have 20 years to retirement, you can take advantage of a little more risk than someone who only has 5 years. But you have to make sure that you're comfortable with how that works over time. So really take a look at your risk tolerance and understand what your comfort level is with watching the markets. And finally, stay committed to time-tested practices, particularly in the area of diversification. By diversifying your investments across the spectrum, stocks, bonds, cash equivalents, you resist the urge to react to market fluctuation, and you get to take advantage of both the ups and downs of the markets over time. And that really will help you manage your investments and give you a better chance of achieving your goals. It's also really important to invest regularly for your future, another time-tested practice. By setting up a regular investment account from your bank account or your paycheck, for example, like a 401k or a 403b plan, you will just get in the habit of investing regularly and won't fall victim to swings in the market. So it's so important that you stick to a regular time period, a regular amount, and you'll take advantage of compounding over time. If you're already investing regularly, have any questions or concerns, talk to your financial advisor, which leads us to our fourth and final focus around your financial fitness, and that is enlist the help of a financial professional if you're not doing so already. So it's really important that you find an advisor with whom you are very comfortable. You can look for recommendations from family or friends, but also it's really important to do your homework as you pick a financial professional to work with. So a couple of things to keep in mind with respect to identifying the best partner for you and your needs, and it's really important that you work with someone who understands your personal circumstance, whether that's your own investing style, how comfortable you are with risk, your tax circumstance. Make sure that person is responsive and will be responsive whenever you have a life change. So talk with an advisor about how he or she handles those situations with their current book of clients, and that will help you in that regard. Also make sure the person is a really good fit and that his or her expertise matches what you need. For example, if there's a financial professional who works mostly with corporate clients, and you're looking for a personal advisor, that might not be the right solution for you. So make sure the person really is a good fit, that you feel comfortable with him or her and going through this journey together. It's also important for an advisor to help you stay focused, that they keep you on track to your goals. They're a good accountability partner to make sure that you are saving and investing toward what you have identified as goals for you and your family. So that is a really good trait in an advisor that you'd work with. And make sure that the person helps develop and monitor your plan for you and works with you when it needs to be adjusted. So whether that's a significant life change, whether that's a job change, a job loss, that your advisor is sticking with you to make adjustments as you go. And also make sure that that person helps you understand fees and expenses. Fees should be transparent. You don't want to be surprised. Walk away from an advisor if they're not going to be forward and candid with you about the fees and expenses, and that you're comfortable in paying the fees for the value that you're getting from the relationship. One of the other things an advisor can help you with as well is a plan for long-term care. So whether that's for you and for your dependents, that you have already articulated how you're looking forward to a long-term care program. So there are a couple things in particular that an advisor can really help you with as you identify a solution that best meets your needs. So first of all, take a look at potential tax advantage vehicles. If a loved one becomes your dependent, consider your own long-term care needs as well. So as you are caring for someone else, you can take a look at what your expectations are, what your wishes are as you move into the later years in your life. And another thing to consider is looking at long-term care insurance as a way to mitigate long-term care costs. So when you talk about potential tax advantage vehicles, one that comes to mind is a health savings account, also known as an HSA. Talk with your advisor about if that is an appropriate tax advantage vehicle for you, if it's good for your long-term needs. And to that end, is talking about your own long-term care needs, you really need to take a little bit of a look in the mirror, and starting with your own personal and family health history. If you have longevity in your family, that's something you should take a look at. If this is an experience that you have already watched for your parents or experienced with your parents, or your parents for your grandparents, those are certainly little facts to consider as you're looking at your own long-term care needs. And also take a look if you're looking to purchase insurance. It's really important to consider this because Medicare does not cover long-term health care costs. Medicaid is typically dependent on income. It's designed for lower income. So there is a chance that you fall right in that gap where you're in a position where you're not eligible for Medicaid. Medicare doesn't cover long-term care, so you're going to need to make up that gap. So that is an important consideration as you work with your advisor and you work with your own long-term care plans. And long-term care insurance is one possible option as funding you or your dependents' long-term care. So a few things to consider there. First of all, evaluate policies specific for your needs from at least 3 insurance carriers. Just like you would be looking at any sort of work on your house or any sort of big expense, get 3 bids. Take a look at least 3 options and understand the costs associated with the policy. So what charges, what changes impact costs, any tax advantages available to you. Does payment for the policy's premium now or in the future fit into your budget or into your financial plan? But make sure you also understand the coverage limitations of the policy you're evaluating. Does it have any limitations that you could see as an issue for you in the foreseeable future? Are there flexible options with that policy? So really dig into the details, and that is something your financial advisor can help you with as well as you consider long-term care insurance. A really important thing that you can do for yourself over this period of time is to keep saving for your retirement. That is a mistake many caregivers make. They either suspend their contributions to their retirement or they take distributions from their own retirement savings. That has a significant impact on your ability to retire comfortably at some point. So really try to keep your savings and your ongoing contributions intact. It's really tempting to want to take that money for needs you have today, but you're really making a precarious future for yourself down the road. So it's really important to consider other potential options of funding to cover caregiving. And one of the things you can take a look at is if your state has options for payment for caregivers, whether that's respite care or a part-time caregiving payment that you could get from your state. So take a look at that. Again, your advisor can help you with that as well. But also look for other alternatives in looking at additional resources that can help you. So the pandemic was a really great example of suddenly the availability of emergency funds. The CARES Act, for example, opened up opportunities to borrow money from your retirement savings with the ability to pay it back in a set time frame. So other things you might want to consider are home equity, maybe even a loan from your retirement plan, because that does get paid back to you, and a hardship withdrawal in the worst case if you need to get access to those retirement savings. But the most important thing is to continue those contributions. If you're participating in a defined contribution plan at work, like a 401k plan or a 403b plan, continue to do so. That comes right out of your paycheck. It's automatic, but that is a way to continue to work for your future as you're taking care of your needs today. In addition to caring for your finances, it is really important to do for you and for your family is to actually have the family money talk before it becomes urgent. The truth of the matter is most of us don't want to have this conversation. It is uncomfortable. We will dread it, but it is an important gift that we can give to our family by actually being very clear about what our wishes are, what our expectations are, and it can really help our families down the road to avoid a really catastrophic moment in time, very emotional and difficult time. So it's an important gift to give your family. Consider a couple of things that baby boomers will hand down about $68 trillion to their heirs, so there's significant money in this conversation, but 60% of mismanaged wealth transfers are attributed to poor communication within the family. So that is not something you want to leave with your kids to have to work through that. So take advantage of the discussion and the opportunity to have the family money talk to really prevent a difficult circumstance for your kids. So there are three main subjects to have in this discussion and to make sure that we cover them: the plan, the finances, and the wishes. When we talk about the plan, it is really important to be very specific about the documentation that's available, where we have it, get it all in order, get the estate plan in order, work with your financial advisor and estate attorney to have that put together, that you're very clear on the expectations of everyone's role, and also that you are also very clear on what your wishes are should you be in that circumstance in which you can't articulate your own wishes at that moment. So in terms of having the talk, there are a couple of things to keep in mind. First of all, setting a date, and second of all, staying on script. And we talk about setting a date for the family money talk. Do not do it over Thanksgiving dinner or at a birthday party or at a family wedding. Any sort of other circumstance, it should not be done then. Set a separate time where you want to get everyone together, that is the sole purpose of the family gathering, to get everything in order, to be very clear on your wishes. So again, stay away from any sort of family, other family celebration, and just be very focused on what you're going to talk about. Encourage your family members to bring their questions, any concerns they have, and get it all out on the table at the same time. And what that can do to help you is minimize surprises, reduce confusion, and really decrease the likelihood of disagreements with your kids. I think all of us have probably had experience or know of friends and family who found themselves in the moment of a catastrophic illness or having to make life and death decisions, significant money decisions at a very emotional and stressful time. And by having this discussion ahead of time, you can alleviate that from your family by being very clear on what you're looking forward to. It's also really important when you have this discussion to stay on script, that you get everyone in the room and stick with your agenda. And be very clear about your purpose. Tell your family that you're ready to discuss these important matters related to your finances, your estate plan, your medical decisions, what your final wishes are, so that everyone hears that information at the same time. And you can even set it up for an example that this is really important to me, that is really important that you all support my wishes and you ask for agreement from everyone in the room. And that is a way to be very clear in terms of stating your purpose. And it's also with respect to sharing your plans. Like, talk about the situation you have right now, what you expect to have going forward, how you came to those conclusions, and you can frame it in something that's familiar to everyone. So you have a friend. I saw Bob and his family go through this experience. It was extremely difficult. I don't want to leave that to you. I want to prevent that circumstance from happening to you. So be very clear in how you came to the decision of having the conversation and why it matters to you. And it's really important to review the documentation and the roles. So make sure your family members have copies or know where to get copies of your important documents, whether that's your financial statements, your estate plan, your medical documents like a durable power of attorney for healthcare decisions, that you have that all available, and be very clear about the individuals who are responsible for executing those decisions. So an executor, a trustee, a power of attorney, your healthcare agent, make sure everyone knows who has those roles. And it is important too to consider the dynamics within your family as you go through this. So you might want to consider having a neutral party. Like I have, for example, I have an estate attorney. He or she has these documents. I expect him or her to execute them as I wish. When that moment comes, please turn to that person to execute my wishes, because I don't want you to have to be burdened with that. So the most important thing around the family money talk is to have it and to be very clear with your expectations to avoid any potential emotional stress and difficulty for your family going forward. And finally, you need to ask your family for a commitment, that they understand your wishes and that they will carry them out as you've asked. And that this entire process may seem overly formal, but each step is really important. And if something happens to you, this meeting can provide all of the information your family needs to execute the wishes that you intended. Remember, you don't have to do it alone. Care needs can happen very suddenly, and there are moments when you will be overwhelmed, but you don't need to take care of all of this by yourself. Reach out to your financial advisor, caregiver alliances, your friends and family, and other experts who can make sure you get the education and the support that you need as you're on this journey. And if you want to talk more and are looking for some additional help, please visit go.americancentury.com/live.